Today, I'd like to talk about interest rates, but on a global basis. As you know, we're coming into December, and this week, if you watch all the Fed governors are all speaking this week, and this is to give us an idea of what they're going to do so there's no surprises in the market. And if you're checking it out, I think we're now up to 74% there will be a cut of at least 25 basis points in December, up from like 40%, and because of the Fed comments. But that's not what I want to concentrate on. In our world right now, many things are going on, and the interest rates are just a small part of this. First, I want to talk about is what is the real GDP growth in the G7. And as you can see, the United States is significantly outperforming our competitors, we'll call them, or other countries or regions. And I want you to remember something, or currencies. There's basically four ways, and I'm going to minus one, which is China. Since only 1.4% of their currency trades free, it's not really an issue. But you have Europe, you have America, and of course you have Japan. And as you can see here, both Europe and Japan are being outperformed. And by the way, look at the United Kingdom with their currency, okay? But even more impressive and more scary for our competitors is our labor productivity. As you can see, has been just crushing the competition. And when you look at Canada, France, Germany, United Kingdom, and Japan, it's not even close. So remember something. When you're looking at a currency, if you're an investor in the world or you're managing money or whatever, right? The currencies are based upon what is the economic underlying performance that the currency represents. It's as simple as that. Now, I know in our parochial world, we look at things as what is the interest rate? Interest rates are not the dominant factor for currency. On a short-term basis, it can be, right? So when you look at somebody like Turkey, who had the 60, 70% inflation, whatever it was, and they raised their interest rates to 65% because their currency was just collapsing, okay? So really, the economic performance of Turkey was killing their currency. The interest rates are just a way to kind of short-term put a Band-Aid on it until they can get a grip on things. Then finally, look at the inflation rates. Here it is obvious that America, again, has way outperformed all our competitors on the inflation front. I understand we just went through an election where they said our economy is terrible and our inflation rate is too high. But you know what? We live in a world, and when you look around the world, we haven't really done that bad of a job. In fact, is we've outperformed everybody by a mile. So what does this mean to us? Well, think about it. If you're reading the papers, the Financial Times, which I read, and you'll see that Europe, they know these numbers, right? Japan know those numbers. So you got Japan with a 280%, for some people, debt ratio to GDP, okay? And they're now passing 140 billion yen stimulus package to get the growth up, okay? Over in Europe, they're fighting right now. Not fighting, they're trying to figure out, what do we do? One, they need to invest so their technology gets better, so they get better productivity, and they need to invest in their industries, which means they have to issue more debt. But go look at the debt to GDP of all the European nations. Other than Germany, which is 60 to 70%, everybody is like 130, 140, 150, okay? America is 120, just to put everything out on the table, okay? So, think about what's going on. Look at what happened with Liz Truss in England, where she decided that she was going to cut taxes, right, and invest money in England. What happened was it killed the bonds, it killed the currency, killed her. She was thrown out, okay? and they stopped all that. Now they're trying to figure out how much they can do, right? Because their deficits are so high, they have to raise the taxes. But if they're raising their taxes, we want growth and we want more productivity. Does that actually equal out? How are they going to do that? It's a dilemma they have to try to solve for. Europe is even more of a special program with the euro, because in the euro, there are 20 countries in the euro. There's 27 countries in the EU, and there's 32 countries in NATO, okay? So they're all mixed up over there, but basically let's concentrate on the euro and the EU, because if they decide to issue bonds for productivity, where do they go invest? And I'll show you how bifurcated Europe is, and why I think the euro has at least a 50-50 chance it's not going to make it. Let's look at just defense just for a second. In the defense world, there's 11 different systems that we have. A tank is a system, an airplane is a system. So there are 11 systems. In America, the biggest defense contractor in the world, we have 33 companies that deliver those 11 systems. In Europe, those 11 systems are delivered by 172 different companies. Just think about the Ukraine-Russian conflict. And when you see, when they're sending their artillery system, everyone has their own artillery system, and they all send 4 or 5, right? There's no compatibility. There's too many people. So when you're in Europe and they say, how are we going to invest the money to increase our productivity? Each one of those 20 countries or 27 countries, depending on how you look at it, are saying, well, invest in my country, don't invest in the other country. How are they going to pull this off? I don't know, okay? So there is nothing economically. I was going to try to do this with America's economics. Our economics are right now through the roof. And given our asset inflation, look where the stock market is, look where crypto is, look where gold and silver is, look where our property prices are. There is literally nothing that is not near or at an all-time high. And more importantly, when the world invests its money for the last year, so everyone invests all across the world, 70% of every dollar invested in stocks and bonds in the world in 2024 was invested in America. 70%. The other day, Friday, I think it was, the American stock markets in total hit an all-time high of 74% of the MSCI index. So we're doing fine. And so why are all our Fed governors out saying that we're going to cut interest rates in December? Literally, if you look at America, it makes 0 sense, in my opinion, okay? Now, they say that our policy is restrictive. Well, if it's restrictive, I hate to see a loose monetary policy, okay? So I don't think we are restrictive. Here's the deal. If we're looking at the inflationary pressures plus our economics, and don't tell me about unemployment, it's 4.3%. We've been one time during World War II, in the first 4 years of the war, during World War II, we were lower. That's it. Every other time we're way higher. And the average for the last 100 years is 5.68%. So our unemployment is not an issue, okay? But what is an issue, if we maintain our interest rates, if we don't cut them, it's gonna hit the euro, it's gonna hit the pound, and it's gonna hit Japan yen, okay? And you look at the yen, it's going down, it's now into the 148s. We may get close to this. And then with China, this is also critically important. China, if we keep our interest rates here, China is going to go down. Now, problem with that is all the EM countries are attached to the yuan, okay? We price the other currencies off the China renminbi, okay? So what does that mean? If the renminbi goes down, then all the EM currencies go down, and they have an inability to invest in America, right? They buy less. That's what it's going to be. So should we cut the interest rates? Shouldn't we? Should we do it for us? Should we do it for them? What do you think? Like and follow. And certainly, tell me what you think in the comments.